Good morning. Let's start our last topic, and the topic is multinational performance measurement and compensation. So the topic is revolving around how we can evaluate the performance of different offices or different subunits or different divisions of the multinational corporations operating at different regions of the world. And how do we compensate their managers, employees, or chief executives of the corporation? So in the corporate world nowadays, most of the compensation, most, not all, but most of the compensation are based on the performance. So it's important that we have to measure the performance of the corporation in a effective and appropriate manner, especially with reference to subunits or subsidiaries operating in different parts of the world, so that their employees are motivated. Because if we are deciding the performance benefits to all the managers on the global basis, on the global profit and loss basis, or a global performance of the corporation. So maybe there is a possibility that some of the employees who are working very hard or working in very effectively for their sub units is going to be demotivated. So for that reason, on nowadays, it's very important that we have to analyze or evaluate the performance most effectively. So what are the learning objectives of this topic is analyze and evaluate alternative measures of financial performance. So we focus on how we measure the financial performance, and definitely there are certain ratios or um, uh, the things that we can calculate in order to see whether the corporation is working according to the objectives of the stakeholders. So we have to look at that way, and there are very focused ratios or calculations that we can determine to find out whether the corporation is financially performing well or not. Evaluate current cost and historical cost asset measurement method. So we also focus on the second aspect, that we see that what is the current cost and what is the historical cost of the assets those owned or controlled by the corporations. The third point is analyze the technical difficulties that arise when comparing the performance of a division operating in different countries. And definitely when the different subunits or different subsidiaries are operating in different countries with a different political setup, with a different cultural setup, with a different economic situations. So in that case, what we have to do, we have finding difficulties to take a one stick yard or one benchmark to compare all the subunits. Evaluate the behavioral effect of salaries and incentives in compensation management. We all know that in economics, we study that human behavior is motivated, or we can change the human behavior with the concept of incentives. So if the salaries and other incentives while working in a corporation is not aligned with the objectives of the corporation overall, then it's very hard to get a good result. So that's what we want to see it from that perspective. Apply strategic concepts to analyze the four level of control and evaluate their usefulness. So these are the five learning objectives of this chapter, what we're going to talk today. Let's start and see that what are the financial and non-financial measures. We discuss in a scorecard, balanced scorecard scheme, in which we emphasize not only the outcome of a financial outcome of the corporation, but also the other things must also be considered, and that's what we call it as a non-financial measures. So firms present financial and non-financial measures for subunits in a balanced scorecard, like as I mentioned, and it is four perspective. One is the financial perspective, which is on the top, and that is going to go effect with the all other aspects as well, like a customer satisfaction or a customer's importance, And then internal business processes, how we can improve the internal business processes, and that is related to the skill set or the training or the growth of the employees, learning and growth of the employee. So these are all the things which are related to each other. If we have a good learning and growth among our employees, so definitely that is going to help us to improve our internal business processes. If the internal business processes improves, that satisfy the customer, and when the satisfaction customers going to translate into our increase in our revenue, and ultimately the profit is going to be increased. So this is the way that it works. Firms assume that improvement in learning and growth will lead to improvement in internal business processes, which leads to improvement in the customer and financial perspective. So must disclose how compensation policy and practice balance risk and return. So we have to devise a policy for compensation of the employees in such a way that they work hard. Not only work hard, they are also taking in a very calculated risk, because risk and reward are there. So we not design the compensation policy in this way that the manager starts taking huge risks, because if the profit, if their compensation is related to the profit, so there is a possibility that they can take more risk. Uh, so we have to design in a way like that, that they are not taking too much risk, and also they are not taking or they are not taking the appropriate level of risk, because without risk it's not possible to grow. So we have to create a balance between risk and the returns. Intense scrutiny of performance measure and compensation policies. Compensation disclosure and analysis section in the annual report. So it is also now in the governance model that we have to disclose at least the C-level executives or C-level executives of the corporation, their compensation, their pay packages, or their the incentives they are getting in the annual report, so that the stockholders and other stakeholders also know that what their managers are getting. Now, this is a overall structure where the corporations are working. Now, you see in the middle, there is a corporation. Now, this corporation has a two important bodies that taking care of the compensation or other measures for performance. That is corporate board of director. The board of director is the supreme regulatory, the supreme body within the organization, within the corporation, that takes care of everything, but they're also to measure the performance of their employees or the managers. Compensation committee. So out of this board of directors, or maybe some non-board of directors, non members of the board of directors can become a constitute a committee. That committee's role is to just take care of their compensation, uh, study different compensation models, and then they have to design the compensation model which is appropriate for the corporation or in line with the business model of the corporation. When they are measuring performance, they have to keep it in mind all these factors which are outside the corporation. And what are these outside corporations environment or factors, or uh, so global governance treaties. So there must be a treaties with the other countries, of the country, parent country, the country in which the headquarter or uh, uh, the the main office or the main corporation parent company is registered. They have a different types of territories with the treaties or with the different countries. Then we have a CSA governance legislation. That's also possible. CRA tax legislation for different countries. There are different, or within the country, how this in Canada, that CRA tax legislation. Provincial stock exchanges and shareholders, activist groups, and industry advisory committee recommendations. So these are the things that we can take care of while deciding the compensation package or compensation for the managers or the employees. Now there are four. Now, if we want to measure just the financial financial aspect. So financial performance of the organization subunit. Then these are the four ratios, or we can say that calculations that can give us a little idea that how the corporation's subunit is performing. Uh, so return on investment. This is very simple, very straightforward ratio we calculate in most of the accounting and areas and analysis of accounting areas, that return on investment. Then we have a residual income. That's a little bit modification in this ratio in order to calculate it, what is really left over for the stakeholders. Economic value added, that how much value they are added economically, and the returns on sale. These are again very similar or very close to the other returns on ROI or ROE or so R as so. ROI is a performance measure that use readily available financial accounting information. So whatever the information, but it is again, that's based on what the previous performance is. What so Because accounting record is for the previous period is available, so we can calculate it. Income over investment, that is ROI. ROI can be broken down according to DuPont method into two components. Now, how we can do this? You see that there is nothing changed. The main ratio is income over investment, which is ROI. But if we divide and multiply this income over investment with the revenue as a numerator and revenue as a denominator, so nothing is going to change because we are multiplying and dividing with the same number. But when we replace these, change their places, like we bring the revenue under income. That's an income over revenue, which is a returns on sale, and revenue over investment, which is investment turnover. So that's why we can also calculate the ROI with the return on sales multiplied by inventory turnover, investment turnover. So returns on sale into investment turnover. What is a benefit of an ROI? This is the most popular approach as it blends all major ingredients of profitability into a single number. So that's a very big advantage of calculating ROI and deciding things on ROI. Also called as accounting rate of return or accrual account rate of return. So these are the different names for ROI we use. But the problem with the ROI is that uh, when comparing ROI across companies, as a figure can be on a different basis. So their accounting periods are different. Their They are taking different types of averages. So it can be different because there is no standard way that we say that, okay, if you are calculating, for example, a subunit working in Europe, a subunit working in Asia, a subunit working in America. So there is no common way that we can say that all they are calculating the ROI is the same thing. So it's a year end or an average or a beginning year. So if the ratios are based on this way. DuPont method shows how change in specific component, income, revenue, or investment can help a firm each reach target ROI. Then comes the residual income, RI. That's a income that's we when we subtract the required rate of return on investment, then the remaining is the excess income. What For example, the shareholders or the investor wants that they want to get 10%. So RI is going to tell us that, okay, the 10% is there, but still we have a 2% or a 3%. That's what we call it as a residual income. So residual income is an accounting measure of income minus a dollar amount for required return and accounting measure of investment or required rate of return into investment. That's going to give us a dollar amount of a required return. And then we subtract it from the income so that we have a residual income. So required rate of return is the company's weighted average cost of capital. We calculated this in the first part of this course, which we call it as an introduction to managerial finance. WAC, we calculated weighted average cost of capital, and you know that weighted when we are saying weighted average cost means that what the cost we are paying as debt and what the cost we are paying as towards the equity, and all together this is what we call it as. And it also depends on how much we have as a weight equity and how much we have a debt, and by this way we calculate a weighted average cost of capital. The after-tax cost of all long-term fundings, required rate of return times the investment is the imputed cost of the investment, and imputed costs are costs recognized in some situations but not in the financial accounting record. So this is the way that they calculated that how much they want, and after that whatever is left is residual income. Problem with RI and ROI, that's hindsight with this calculation or based on these measure the performance. RI promotes a focus on maximizing an absolute dollar amount, including goal congruence. Maximizing ROI may result in a suboptimal performance. Why it is happening like this? Managers earning high ROI may reject projects that earn more than the company's required rate of return. So the manager say ROI, we calculate it, and then if it is good, then say okay, then required rate of return or rate of return on investment. If we see that we are meeting the targets, so why should we take more risk in order to increase the profit? So then the managers become reluctant to take those projects which have a more ROI than the company's targeted one. So managers earning low ROI may accept projects that earn less than the company's required rate of return. That is also possibly because they avoid risk and they want to take it those projects with a low ROI. The third one indicator or the measure of performance of a subunits of a multinational corporation is economic value added, EVA. EVA is a specific type of a residual income calculation. So again, this is based on RI. It's a modification in the RI method that has recently gained popularity. Does not use a reported GAAP accrual in the numerator. So this is not from the financial statement. So what we are doing, we are taking after tax operating income minus what we are taking here, weighted average cost of capital, WACC, into total assets minus current liabilities. Total assets minus current liabilities. Definitely, if we subtract the from total asset, the current assets, the rest of the two things are debt and equity. Debt and equity. Long-term liabilities means debt, and the equity, the other thing is equity. So we get that value and multiply with the weighted average cost of capital and figure it out. This is our required or what we want, like for a residual income model, and minus the operating income. So in this way, it's very similar to RI, but we change a little bit in order. So key calculation is the weighted average cost of capital here in this case. And the last one is returns on sale is simple income divided by sales, simple to compute and widely understood. Returns on sale, that how much we are selling and out of which how much we are earning. So it also reflects the performance in a way that they are running their business in such a way that the cost is low. Whatever their revenue generate, a big chunk of that revenue is going towards their income or a profit. So how we can select out of these four different methods of measuring performance. Multiple periods of evaluations are sometimes appropriate, like we apply these ratios to not only to a single period, but on a multiple periods. So ROI and RI or EVA and ROS, return on sales, all basically evaluate one period of time. However, they may be adapted to evaluate multiple periods of time. So prevent actions that cause short-term increase in these measures, but conflict with the long-term interest of the organization. And benefits of action taken in current year may take several years to be measured. So these are the uh, defining investment, how we define the investment, because we are calculating return on investment and all. So four possible alternatives of a definition of investment: total assets available, that can be a one definition for investment; total assets employed, total assets employed minus current liabilities, or shareholders equity. So these are different definitions of, and that's the reason we mentioned in the beginning that if someone is calculating this ROI on the different basis, and taking the investment of a different definition, and someone is taking a different definition, so it's going to be not working very well in comparison of different subunits. So we can select any one of the definitions out of these four definitions of investment. Choosing measurement alternatives for performance measures. So possible alternative definition of cost is current cost, or gross value of fixed assets, or net book value of fixed assets. So these are also the alternative definitions of cost. Now, the current cost, the cost of purchasing an identical asset today to the one and currently held, the cost of acquiring the services provided by that asset if an identical assets can be currently purchased. ROI calculating using current cost will differ from those calculating using historical cost. So in accounting, it's very important to, and you already know these issues in accounting, that if we are calculating the ratios on the basis of a historical cost, because assets are normally reported in the balance sheet with the historical cost minus accumulated depreciation. So we get a different values, we get a different figures. So it's important that which cost we are taking. Then comes the long-term assets, cost measured at gross book value, original cost, or cost measured at net book value, original cost less accumulated depreciation, just as I mentioned. Using net book value results in a higher ROI due to the smaller base. Net book value is consistent with total assets shown on the balance sheet, and the net income includes depreciation expense. So incentives for retaining old property, plant, and equipment. So there is a possibility that if we are calculating on the net basis, so what is going to happen? Because the old assets and old property and plants have a zero book value, so that is not going to affect their ratio of, so they retain it. That's so why they, so historical, choose target level of performance, and then select performance goals. So historically driven targets used to set target goals that may include a continuous improvement component. Now, selecting performance goal, book value accounting measures are widely used. Most ensures that the budget is tailored to a particular subunit and the particular accounting data. A continuous improvement component, initial selection of performance measure is less important than measure the change in the measure consistently. Choosing the timing of the feedback. Timing of the feedback depends on how critical the information is for the success of the organization. The specific level of management receives the feedback, the sophistication of the organization information technology. So these are all the things that determines the time and the feedback, what type of feedback they are getting in order to make improvement. So if the feedback is real time or very accurately within a reasonable time, so that improves the systems or improve the situation. But if the feedback is delayed when the events has already occurred, and then it is not so effective. It is effective, in fact, but it is not so effective for the current situation. This is the first part of our topic. The topic is measurement of performance of multinational corporations.